Hi, I'm Randy McMullin with Amstar Mortgage Network. Everybody wants to know how much do they qualify for. It's a very important part of the home buying process and looking at the right price of the house when you're starting out. So the answer to that question, really, there are a lot of variables to that. It's going to depend on whether a conventional loan is the best loan for you or whether an FHA loan might be the best loan for you. So we have to look at those options first. If you're making a larger down payment, in most cases, the conventional loan is going to work better. If you're making a smaller down payment, then we need to compare those options and see which one would work best for you. As an example, one of the main things that an underwriter is going to look at is called your debt to income ratio. It's a simple calculation where they measure your amount of debt divided by your income. On a conventional loan, you're actually allowed to go up to 50% on a debt ratio. Now, that's not to say that everybody would get approved for 50%, but that's the maximum number. On an FHA loan, the maximum number is 57%, so it has a little more flexibility in the underwriting guidelines for your debt to income ratio. One of the things that you need to do is get pre-qualified in advance so you know what your number is. It's going to be based on your income. And one of the things that a lot of people don't understand is the way that an underwriter looks at your income. That's very different from the way that you might look at your income. I'll give you a couple of examples. If you get a job with a bonus or commission, and this year you earned a $20,000 bonus or $20,000 commission, you're thinking that's a part of your income. Underwriters don't see it that way. They're going to look for a 2-year history, and they're going to want to average your income over a 2-year period. Another part of debt to income ratio is how underwriters are going to look at your debts. A classic example is student loans. For example, a lot of people may have a student loan that's been deferred for a year or two, and in that case, you're thinking, I don't have any debt that needs to be counted. But that's not how it works from an underwriting guideline standpoint. Fannie Mae and FHA both have very specific requirements for using student loans. FHA, for example, will use 1% of the outstanding balance on that loan as a debt. So if you have a $30,000 student loan, even if you have no payment, the underwriter is going to count $300 a month in your debt to income ratio calculation. Fannie Mae works a little differently. If you have a $30,000 debt, but the loan credit report says that your monthly payment is $150 a month, they will only use $150 a month in that calculation. So as you can see, there are a lot of variables on how this is calculated. The best advice that I can give you is give us a call, send us an email, let us know what your situation is. We'll pre-qualify you up front with no obligation and no cost. If there's anything that we can do for you, really all you need to do is just give us a call. I'm Randy McMullin with Amstar Mortgage Network. Thank you very much for your time.